It's another beautiful day here in Lake Tahoe on June 19th, 2024. Today's guest is Jeremy Olen. He is a seasoned finance expert with experience ranging from technology and quant strategies to entrepreneurship, having started several businesses and a hedge fund. He's also successfully launched 2 ETFs and earned his CFA designation in 2006. After several mergers, he now serves as the Chief Investment Officer and National Managing Director of Mariner Advisor Network, where he and his team oversee several $1 billion in assets. Jeremy, welcome to Tahoe Minds.
Thank you. Thank you for having me. I'm excited to be here.
So we'll just start off by talking about how you started your career as a more math and tech focused guy. How did you end up managing several $1 billion in the position where you are now? How did that transition happen?
So formal education was mathematics and actuarial science at the University of Michigan. And so that really gave me a pretty strong background in mathematics and finance. I tried my hand at being an actuary in the early 90s, and it wasn't for me. So I ended up quitting my very first job. I probably lasted about 90 days working for a big insurance company, coming right out of college, and stuffed in a room with 3 other guys on the interior of a high rise, and I just couldn't imagine life being like that. So in the early 90s, the job market was also pretty bad in finance, right? So that was the savings and loan scandal. We had very high unemployment, and so jobs in finance weren't, there weren't a lot of jobs in finance. So I made a decision to head to Colorado and lived in Telluride for a year, and I was a ski bum. When I decided to return back home to the Detroit area, I realized as much as I loved being a ski bum, being able to use the skills that I'd learned, hopefully having a career as a professional was really important to me. It was a huge lesson for me in just understanding what I wanted. And so when I returned to the Detroit area, the job market was still pretty bad, but if you had a degree in mathematics, there were some software companies. So we're talking 1993 now, that would hire you, teach you to program. And that's how I actually ended up getting into the tech side of the world, where I spent the next 7 years working in tech, to include, I did a brief stint working for our neighbor here at Sun Microsystems.
That's awesome. And so you've also founded your first company, 3D Media, in 1999. Could you walk us through that story and what inspired you to start that, what the company did, and any challenges you faced along the way?
You bet. So I did a good stint of my career, the initial tech part of my career, working for some fairly large corporations. Then also more self-discovery, realized that I wanted to be an entrepreneur. I wanted to build a business of my own for all kinds of reasons, but mostly just because I was inspired to do that. So I left a company, we were doing government software, company called New World Systems. I left that company with their chief technology officer. Late 90s, the evolution of computer animation was really starting to take root, right? All of a sudden, it's funny to even think about it today, but back then, all of a sudden, with a fairly large farm of computers, you could start creating 3D animation, right? Doing 3D drawings and then turning them into motion and those types of things. And so we really grabbed onto that technology, and we started to deliver computer animation to large companies in the Detroit area. We were real fortunate. We got some contracts with the U.S. Army. They have a big tank plant and research development plant in the Detroit area. And we were doing 3D designs for new tanks or hit avoidance systems and all those kinds of things.
With that new 3D modeling
With the
technology.
new 3D modeling, we were actually helping the Army research go to their shows their sales shows. They actually have those kinds of shows in the Army, and they present and show off the future of warfare. And we would literally create, basically marketing for them using computer animation and taking these ideas and bringing them to life and those types of things. So that was 3D New Media. That was headquartered in Birmingham, Michigan. And then I left that partnership and sold my interest back to my other partner right about 2000.
I see. And why did you do that, or what was the thinking behind that? Did you want to start something else, or?
I really didn't. That was actually mostly because it was not a good partnership. And he and I, he has since passed away, but he and I remained very close friends. But we just weren't aligned as far as where we wanted to take the business. And, I think I wanted to probably grow it a lot faster and bigger. And he was a real hands-on, kind of keep it more manageable type of guy. And we just never saw eye to eye. And so that was more of that was an exit based on the partnership. More so than the business model.
Got you. And what were some of your toughest challenges with that first business? What do you think was the hardest thing about scaling such a small company and such an innovative and new industry?
For one, we did not know anything. I mean, we thought we did, but we really didn't know anything about running a business, to include how to source capital in order to grow it. We did source a little capital, but then really how to use that capital effectively. The other thing that I discovered for me was that, and I love innovation, don't get me wrong, but we were really trying to innovate and go into a market where there wasn't yet a market, and that was really challenging. One of the lessons that I learned when I left there was that, for me, couple of things. I wanted to get into a business where I would have more predictable and recurring type of revenue. So that was very much a hunt and kill kind of business. I mean, we did get some big military contracts and we would feed off of them, but we really never knew, revenues could be extremely volatile. We were always kind of hoping and praying on someone to renew a contract and those types of things. So that was really challenging.
And so that's when you started to make the switch into finance, right? And
Yep.
Did you work at JBT Financial right after that?
I did. So I had some family members that were financial advisors. Back then, they were more a lot of financial advisors were really life insurance salespeople. So the evolution of being a financial advisor in the 80s and 90s, they were more doing estate planning, selling life insurance to fund buy sell agreement, those types of things. That was more traditional. In the 90s, during the 90s, this group had picked up a little bit of money, sticking them in mutual funds and stuff for their clients, but that wasn't the core of their business. So right as I came out of the tech business, one of the family members had said, hey, would you take a look at, we're really good at doing what we do, estate planning, selling life insurance, those types of things, but we started to gather some, and it was like nothing. It wasn't a lot, right? So it was maybe 40 clients. They had like $8 or $9 million that was being invested, but they didn't know what they were doing. And so they wanted some help just to take a look at that element of their business and make sure that they were doing a good job for their clients. And that's when I had a bit of an aha moment of saying, when I looked at what's going on there on the retail side of asset management. Now, I had seen what it looked like on the institutional side back in my actuarial days. And what I realized is there was this huge mismatch between how an institution managed its money, its assets, versus how a retail client at that time was having their investments managed. And that's the light bulb kind of went on for me, and I thought, hey, wouldn't it be nice if we could bring some of that institutional thinking to the retail side of the business? And that's really where I got my jump, because it's really hard as a young person. You decide you want to be a money manager or whatever, a hedge fund manager, of course, nobody's going to give you any money to manage because you've got right, understandably. And so I had a really nice opportunity leveraging these financial advisors. I pretty much picked up that entire $9 million to manage.
Wow.
Right? We just literally went to them and said, hey, here's what you got. It's good. There's a better way. This is how an institution would manage these assets. And all of a sudden, that 9 million went to 20, went to 40, went to 60. This is like 01, 02, because we had managed it prudently, et cetera. We really, did a nice job of managing the tech crash and some of that early 2000 volatility. Yeah. And so that really started to carry me. Now all of a sudden I had some years and success and track record under my belt as far as being an investment manager, as well as, starting to get some people in the Detroit area that, would also give me a good reference and trusted me. So
for
that
sure.
was kind of the jump into asset management.
And you were spearheading that whole thing. That
I
was all led by
I
you.
was.
Awesome.
Almost right away I saw the opportunity and decided, okay, I'm going to wrap this in a business entity, in a business wrapper. And so I think it was probably 02, 03, whatever, I actually formed Dynamic Capital just to focus on that business.
I see. And how did you mentioned briefly the tech bubble. How did you navigate managing so much money during a pretty big bubble crash?
Well, so the tech bubble was a big bubble, but in tech. And the retail investor in particular was just way overloaded in tech, of course, right? Everybody and their brother was making, ridiculous returns, buying, petshirts.com, it was madness. And so, that one was an easy one to navigate because if you were diversified, sure, maybe 5% of your portfolio was in tech because it should be, but if you were well diversified and you'd own equities and other asset classes like value as an example, or you were diversified into other asset classes like if you had good diversification during that period of time, you weathered that storm, no problem. So that was an easy one to see coming. It was just unfortunately the people who had 100% of their money in red hot tech stocks that got clobbered.
And so during your time at JBT, you developed Quantitative Allocation Methodology.
Yep.
How does, for people that might be a little more quantitatively challenged, how do you explain that in simple terms, and how does it differ from a traditional investment strategy?
Yep. So what I wanted to do is create a narrative around this idea of taking institutional asset management and bringing it to the retail investor. So again, there wasn't really anything new when I started to actually document. And I'm a quant guy. I like to document processes as I go. And so really what I did is I took some of the underpinnings of basic CFA 101 investing principles that I saw being used well in the institutional realm, and I really just documented that process so that we could communicate it to a retail investor. And it was simple things like really taking some of the underpinnings of modern portfolio theory, right? Which brilliant, Harry Markowitz. But anyways, what I did is I took those basic principles and I put it in a process so that we could start to explain that to a basic retail client, which said, hey, great, we're going to diversify a portfolio, right? The best way to manage risk, my humble opinion, is through diversification. Because otherwise you got to try to, time the market, get in, get out, all those kinds of things. I've never been good at that. I actually haven't met anyone who's been amazing at that over a long period of time, right? Broken clocks were right twice a day or whatever. But so diversification really, really makes a lot of sense. But on the retail side of the spectrum, people were, one, looking at diversification using elements of the past, right? And so saying, hey, well, if bonds are a good diversifier for stocks, then, and they have been in the past, well, I'm going to keep using that going forward. And while you can learn a lot from the past, right? Institutional investments, it's all forward looking. A great example is we had this 20-year bull market in bonds, right? That's because interest rates over a 20-year period went from whatever they were, 8%, down to almost zero. That was this huge secular trend. Well, they were a great diversifier. Bonds were in a bull market, and when stocks would drop, in 08, 09 is a great example. Hey, if you own long-term US Treasury bonds, you had this great ballast in your portfolio. Well, looking forward, when interest rates are zero or whatever, super low, I don't want to use those elements of the past to necessarily think that's going to be the same diversification. Some huge kind of gaps, again, that the institutional guys don't think this way, but that's how the retail folks were designing portfolios. It's all on the past versus looking forward, and kind of reshaping how you might use diversification to manage a portfolio. Or one of the other things was just the concept of managing downside risk, because diversification, I would argue, is only really important in a downward market. And so you actually don't want to necessarily use data points of, hey, we've got a nice upward trending market or sideways market. Hey, these asset classes, look, they're non-correlated. They diversify each other really well. What you need to look at is the tail risk, and during a down market, do those assets all fall together, which is the case of a lot of asset classes. So again, we just started to take some basic fundamentals of institutional investing and apply that, sort of make them more retail friendly. And we would use those variables, those quantitative variables, then to design retail portfolios, right? So design more with forward-looking capital market expectations, with portfolios designed for diversification, but in a downward market, those types of things. And so that was the quantitative allocation method, which would just include some simple things like, hey, rebalancing a portfolio using variance or drift-based rebalancing. And again, something I saw all the time in retail, but I didn't see necessarily, or I saw institutional, but I didn't see in retail, was you don't rebalance a portfolio once a year, every quarter, with just some arbitrary metric. You rebalance it if you've got a 60-40 portfolio, right? 60 stocks, 40 bonds, just assuming that's an allocation that would make sense for someone. You rebalance it when say the stock market's running, that 60% goes to 70% and the bonds go to 30. Well, now I've got more stocks, I've got a riskier portfolio in a riskier market, and that riskier portfolio might not be so aligned with the objectives of the investor anymore as well, because their objectives were 60-40. And so you simply go from 70-30 back to 60-40, forces some sell high, buy low discipline. It manages the risk. Nothing new, but again, bringing that into a framework and a process to all those things into a retail portfolio. That was very long-winded, but that was the quantitative allocation method. And all I did was document all that, throw a trademark on it. And it was a recipe that, as I started to grow the asset management side of my business, was extremely helpful, because what I did is I took that success that I had in Michigan, and I met a guy at a conference in Arizona some years later as we were starting to have success. And he said, hey, I've got this really big group of financial advisors on the West Coast, primarily in Northern California, but all over California and some other states as well. And he said, I really like what you're doing for these folks in Michigan. Why don't you come out to California and talk to some of these financial advisors? I'd bet they'd want to work with you. And that's what I did. So suddenly I went from working with just one financial advisor to 5, 10, etc. And that really started again carry some momentum as far as the capital that I was raising. But also I had to develop a framework to take what we were doing, then educate a financial advisor, and then help the financial advisor educate the client. And again, that's why I think that allocation method was so important, because it was something that could carry that message down all the way down to the actual end client.
For sure. And how do you, when you are managing these financial advisors?
So I would contract with the financial advisors, and I would literally take over the separate accounts for the individual clients.
And how did you make money? Were the financial advisors, were they paying you, or were you getting a percentage of their investors' returns, or what was?
So this was perfect for me, because a financial advisor typically, if they're going to manage money for a retail client, they'll charge a percentage fee on the assets. They actually do. If a financial advisor is registered with a broker-dealer, and it's a really messy world of financial advisors, some are just registered and they're fee only with the SEC, but a lot of them, especially back in the day, also carried licenses as brokers. And they would be licensed, carry their licenses, their 7 licenses with like a broker-dealer. And in that world, you actually couldn't take performance types of fees, but you could charge a 1% fee to manage someone's money or whatever. And you'd collect on that fee every quarter. And that really, I love that model, because all of a sudden, there's recurring revenue here.
Yes.
You get 1% a year, and sure, there might be some market volatility, but it was those fees were pretty predictable. And so all I did was charge the financial advisors a percentage of their fee.
Okay.
So like back then, if they were charging 1%, I might take a quarter of that to do the investment part of their job.
That's very interesting. Yeah. Okay. And so that was during your time at Dynamic Capital Management?
Yes, exactly. So I hooked up with JBT Financial, took over their asset management, and very quickly opened Dynamic Capital, and they were my first client. Moved to California and started to add a whole bunch of other financial advisors to as clients of Dynamic Capital. So the financial advisors were using Dynamic Capital to manage their clients' monies.
I see.
Right. So in a lot of ways, I was a third-party money manager.
For sure.
Yeah.
And how did you spin that into, or not spin it, but how did you go from doing that into starting a hedge fund, and at that focus on natural resources? Where did that come from?
So, and they weren't separate. So I was running Dynamic Capital. I always liked the hedge fund side of the business for a couple reasons. One is I thought the percentage, well, of course, I'd look at the New York Times and see these hedge fund managers, and they seemed just so wildly successful, and it was sexy and all the things. So I was attracted to that. I was also attracted to the idea that, hey, I could get into a different realm of fees where I could take a performance fee, right? So 2 and 20 is a whole lot better, could be a whole lot better than 25 basis points So.
And that is 2% management fee and 20% of the upside.
Of the upside, yes, exactly, right? So, if your hedge fund's up 20%, you have a 4%, 20% of that's, you're going to get 4% of the assets you're managing, plus the 2 you get automatically, that's 6%, right? And, obviously it could be extremely potentially lucrative. But again, I'd come from the institutional space, so in the world of managing retail money, it was mostly liquid securities, right? ETFs, mutual funds, stocks, bonds, all those kinds of things. And I mentioned diversification in a downward market. It's actually can be quite hard in that liquid market to find. Sometimes all boats rise and all boats fall. So I was also always a big fan of alternative investments that could be truly non-correlated to the market. And so that was in the world of hedge funds, et cetera. In fact, some of what I would do for the retail clients is we were allocating capital out to alternatives, right? Alternative strategies or managers or hedge fund managers that would give us some additional diversification benefit in a downward market. So I was intrigued with the space. I wanted to get in it, and I had just moved into a neighborhood in Sacramento. I was taking out the garbage, and I meet my neighbor. We're both taking out the garbage at the same time. And he's just this amazing guy. We hit it off right away. And he's a geophysicist, right? And the more I got to know him, the more I started to realize he had some really, really good, and he was a pretty active personal investor, but he had really good insight and understanding into this whole world of natural resources. Oh, by the way, right? So this is 04, 05, 06. We're in a bull market, right? You remember, you don't remember, but a lot of us will remember, we saw oil go up to $140 a barrel, right? I mean, and China and this whole demand and the global energy portfolio. And so I had this aha moment. This guy is really good at understanding natural resources and the trends in natural resources and the price trends in the commodities behind those. And I'm going to leverage that knowledge because I know how to make the trades. I know actually how to execute on those strategies. If he tells me he thinks this is going to do that and this is going to do that, then we can actually put those trades on. And so dynamic capital was growing very nicely, but then we actually launched a hedge fund in, I think we probably launched it in 2006. And it was natural resources because he had that intellectual capital. Yeah.
Awesome. And what was the balance between normal assets and sort of alternative investments like natural resources? Was it
in the hedge fund?
Yeah, in the hedge fund.
The hedge fund was 100% long short natural resources. So, but not just we weren't just investing in commodities or commodity prices. We were also investing in natural resource companies.
I see.
In fact, I'll jump onto that. So as we started to look at the hedge fund portfolio and recognizing areas of the market that we wanted to invest in, we actually discovered that there was a key exchange trade. There was actually a couple missing back then. So the ETF revolution happens, SPY and the cubes and stuff, right? Those are the kind of the late 90s. They really start to take hold, I would argue, in the 2000s. Now you start to get some more ETFs coming out, but there was still there wasn't everything. There probably is everything now, but we realized there wasn't a coal ETF, and we liked coal, right? I mean, not because I'm all for the environment and all those types of things. But back then, coal-fired electricity was still like 51% of the global energy portfolio, 51%. And we knew the global energy portfolio was going to continue to grow. Even if coal, which it should, was going from 50 to 49 to 48, didn't matter because the world's using more and more energy. And we actually loved nuclear energy. It was one of the worst trades we ever made because we were like, oh my God, this is amazing. It's clean, it's cost effective, yada, yada, boom, Japan, didn't see that one coming. But we had invested heavily in nuclear energy. But when you run a hedge fund, as much as you might like investing in specific coal companies or nuclear energy companies or whatever and going long short, to have an index or an ETF to use as a kind of a catch-all or round out the position or, have some options to run against it to control the beta of the portfolio, those types of things. We actually had recognized there isn't a nuclear energy ETF out there, and there should be. ETF makes sense if there's enough market cap to actually fill the ETF up, et cetera, right? There might be some great ideas out there, but there's no either companies that are really focused in that sector, right? And or or enough publicly traded companies to make an ETF, but we were like, there's enough nuclear energy companies. And we started to kind of kick around the idea of launching an ETF for nuclear energy. I actually called some guys I knew at Power Shares in Chicago. I'm like, hey, what do you think about this idea? And they're like, oh, that's actually a pretty good idea. And then, my neighbor comes over with the journal like a month later, and he's like, look, someone just launched a nuclear energy ETF. It was actually Van Eck. We were like, oh man, we missed it. So I actually picked up the phone and I called Van Eck and I said, hey, I have congratulations on your ETF, great idea. We think we've got another really great idea for an ETF. And they were like, okay, well, here's how you would go about doing it. And they gave us the recipe, which was step one, you got to publish the index. Not all ETFs anymore are index based. Most of them are, right? A passive index, just an algorithm or a mathematical set of rules to design what the underlying basket of stocks will be in that ETF. And so we partnered with a company, S Networks in New York City, got to work on publishing that algorithm. Sure enough, Van Eck was like, we like it. They licensed it. And so we launched our first ETF in 2007. It was KOL, KOL. We launched a second one. It wasn't energy related, but we saw a big gap. There wasn't a casino or a gaming ETF out there, so BJK. So we launched the second ETF actually pretty shortly thereafter. But yeah, it was the work we were doing, the hedge fund that gave us the ETF idea. And yeah.
We'll circle back to the ETF stuff.
Yep.
But I do want to ask you, how do you manage diversification and managing the downside when you're 100% in natural resources and natural resource companies?
So you would use a short position.
Okay, I see. And we talked about the 60-40 split of stocks and bonds. Was there a type of 60-40 split, long and short?
A couple of things for sure. So a lot of long-short managers will carry a mandate where they got to be at least, they're never more than 30% short or 70%, there's typically 70-30. And so they'll kind of carry a mandate. Actually 70-30, 80-20, that is typical for a long short manager, right? So they'll be kind of mostly long, but they'll be trying to add some alpha or manage risk, et cetera, by being short, et cetera. Versus a market neutral strategy where that's really going to be like 50-50. They're not really long the overall market. They're like every trade's, hey, I'm long Ford, short GM, and I'm just going to play. It's almost market neutral, right? As long as I said long Ford, I think short GM. As long as Ford does better than GM, even if the market's dropping, they're going to get that delta in between, right? We weren't that type of strategy, but we were a hedge fund, so we didn't necessarily have a mandate to be any more. And as much as I hate market timing, we could absolutely use other instruments to hedge risk, to include, we could have gone all cash, right? Or bought bonds if we thought that was going to be a diversifier. So even though we were natural resources focused, being a hedge fund, we didn't have a whole lot of constraints. We didn't have a prospectus like a mutual fund might have to adhere to. And so we did all those things. We'd be short. Sometimes we would have a real high cash position. Sometimes we even bought bonds to try to manage some of the volatility in that natural resources market. 2009 took us out. We did not lose a ton of money, but we lost enough. And then our investors that were invested in our hedge fund, that commodities, it just became not attractive to a lot of people. So a lot of people packed up their money and put it back under the mattress for a while. We weren't that big anyway, and so that was the end of our run as hedge fund managers.
I see.
I think we closed up at the end of 2010 or 2011.
And you were partnering with that neighbor, that geophysicist.
Yeah.
Are there any stories that you have about maybe timing the market because of his, or profiting off of his knowledge and insight into the natural resource market? Are there any cool stories that something came out and you were able to capitalize on it?
Yeah, for sure. I mean, he was spot on. The underlying supply and demand profile of really anything. So we were heavily invested in oil and in coal, but it really didn't matter. But the hard part about a bull market and a trend is, right, you go from $40, $50 a barrel to 60, 70 to 80, 90, and you start to think, this can't go much higher, right? And so we absolutely rode that trend almost as far as it could go. I mean, we were in at 40 and, starting to really hedge our positions out at 130, 140. And so I was terrified, right? Because I was more like, hey, Warren Buffett says, like, you never get out too early. Like, it's okay to get out early, So I get in late. But he really had strong opinions on the data and the underlying supply and demand for that. Just, hey, here's the inventory, here's the demand. This thing can keep going. But no, I have some more fun stories about him. Awesome guy. And I shouldn't even say this because this is probably me too, but quintessential mad professor type, etc. And when we were out raising money for our hedge fund, we had a lot of fun. But some of the guys that we raised money from had some pretty nice boats, and we went for a raise on one of these guys' boats. Well, I mean, we're about 20 minutes into the cruise, going out from, I don't know, Fort Lauderdale or something like that for an all-day thing. And he had never told anyone he's deathly seasick. And anyways, super funny story. But I have it was bad, really bad for him. I think he literally was in shock by the time we got him back to the deck. But he was an awesome guy. But at the same time, so he usually had it right, but we were really designed to be longer term, more upward trending investors. And so when the market fell apart in 09, 010, we just didn't have enough. It was just not in our wheelhouse to be like 100% short the market or, the commodity and keep profiting. So, yeah.
That makes sense.
Yep.
You talked briefly about raising money for the hedge fund and how fun that was. How did you leverage your previous experience as a financial advisor to then go to investors and raise money from them? How did you?
That's exactly that's exactly what I did.
And strategically, what does that look like tactically?
The advisors that I was partnered with, this big group in California, the folks in Michigan, really served the mass affluent market. And so they weren't the high net worth or ultra high net worth folks. These were people with, $500,000, $1 million, a couple $1 million. Like, that was kind of the sweet spot. So actually the investors that I knew were not necessarily good candidates. Those aren't typically the accredited investors for hedge funds. But there were a few. So each advisor, even though their bread and butter was the mass affluent, most of them had maybe one or two high net worth clients. And so I just carved off that list and grabbed my partner and, flew to these spots and one-on-one said, hey, this is our concept. And we started to raise capital.
Wow.
Yeah.
That's awesome.
Yeah.
There's also this notion in Wall Street and outside of Wall Street that the vast majority of hedge funds don't beat the market.
Yes.
You touched on this briefly as hedge funds being a place for investors to store their money as a diversification device.
Yes.
Why else? What are some other reasons why people should invest in a hedge fund? Not just everyday people, but why should these accredited investors consider hedge funds?
Right. I do think the number one reason is diversification. And even though it all depends on a time period, right? And I think that a lot of times if you look at a 30-year time horizon, you'd be like, well, nothing has beat the S&P 500. Now, I do think that's a really important lesson. If you looked at my personal portfolio, like I'm kind of like just got a handful of ETFs as far as like, and SPY is one of them. Yeah. And people are like, why don't you invest in, the NASDAQ, and what about NVIDIA? And I'm like, you haven't looked. Like NVIDIA, like they are the S&P 500 now,
yes,
right?
Yes.
It's not,
Very true.
So, and so if you look at that 30-year time horizon, and you might argue that's going to be true going forward, like it is hard to beat the S&P 500. The challenge is that's a little bit easier to think of if you're an institution with a really long time horizon, but like sequence of returns is really important. So point to point, but if you're 50 here and 60 here and 70 and you can't afford a market crash, and you don't have the same time horizon, et cetera, it's not as easy to think about something like you really have to think about sequence of returns, managing risk. And so diversification is hugely important. How do I put my money into, yes, something that's going to appreciate in value, but as importantly, especially, if I don't have as many inflows, my time horizon starts to get shorter, et cetera, if I'm going to really need diversification, an alternative investment, a hedge fund, can be an exceptional tool. The right one can be an exceptional tool for that diversification. Because, over a 10-year period, the longer you stretch that out, there will be very few hedge funds, and it would be probably pretty hard to pick the ones that are going to outperform the S&P 500. Sure. But for a retail investor, it's not just about total return, it's about risk-adjusted return, it's about diversification. And so I think that it's a great tool for that. And one of the reasons is hedge funds have the opportunity, if you're just in a publicly traded market, you're missing out on this entire world of investment opportunities, right? I mean, the nice thing about a hedge fund is it can go into a private company and invest in, right? And whether they're using venture capital, all these different tools. And so that is a really good opportunity set that I think a smart investor would not necessarily want to miss out on, even if they had a huge time horizon, et cetera, because despite the past and the outperformance of the S&P 500, things do shift and change. That may not necessarily be the case. So it's a really good asset class for the right investor to consider, for sure.
That makes a lot of sense. And I also wanted to ask you about how you manage relationships with these clients, with these investors, keeping them happy, making sure they don't, pull their money. Yeah. What does that look like?
Yeah. So over time, I would say the good news for me, because that's really hard, there's two things I was always amazed at financial advisors. It's why I wanted them to be my clients and not necessarily have to work with the retail side. Yes, we had retail investors investing in the hedge fund, but they were a bit of a different animal because they were the ultra high net worth. And I would say a lot of them thought a lot more like an institution would. And the money they were investing in our hedge fund wasn't their entire retire rate. So it was a different animal. And that was about good communication and just good relationships, building a good relationship. Dale Carnegie 101 stuff is what I mean. Yeah. It was really what we tried to leverage and have really good communications. But I always felt fortunate because I was always amazed at the financial advisor's ability to go out and sell and gather, back then you can't do it as much anymore, but make cold calls, do seminar. I mean, just they were great salespeople. Yeah. And I could never necessarily, and I ran a bunch of companies, and I had salespeople, and I could never, sometimes you would think, oh, this person's going to be a great salesperson, but they want is just this really interesting thing some people have where they're truly great salespeople. So the financial advisors I had were successful ones, so they were not only great at sales, but they were also great at managing the client relationships. What I noticed, the great financial advisor, the great ones, and I was fortunate because I worked with the great ones, we had pretty high minimums for taking on a financial advisor as a client at Dynamic Capital. So the ones we took on were very successful. They were the ones that were there when times were bad for their clients. When the sun was out and everything was good, whether it was in their lives or in the markets, that's easy. It was the tech crash. It was certainly the great financial crisis. 2011 was also a horrible market, right? We almost had a global banking crisis. Markets took this huge thought it was '08 all over again. Then of course central bank, thank God I would argue, central bank stepped in, everything. But these were the advisors that when things were really rough or rough in their clients' lives, man, they were like there. Yeah. And that's kind of something I think I really took as, if I ever had to do that or if I needed a team to do that, like that was super important. Yeah.
So right now you manage several $1 billion. When you were just starting out at Dynamic Capital or at JBT, you were managing much less. So
yes.
How did the strategies change between the two, and which do you prefer? Managing billions and billions of dollars or a couple millions?
So actually on the retail side, so the hedge fund's different. So Dynamic Capital, I actually took the same recipe that I had with JBT Financial's clients, right? So first advisor clients, JBT Financial, and they've got all these clients. We manage the money in separate accounts using this quantitative allocation method. And then as I started to pick up more advisors, same thing. We would just manage the client separate accounts for each individual client using the same method. And that just continued to scale. It actually has barely changed.
Wow.
The portfolios change because if you remember, the method says, let's look forward and set some expectations on this financial instrument or asset class or whatever. Is it going to give us some appreciation? And is it going to provide diversification benefit? And that's something called mean variance optimization. And it's a way you can actually mathematically design a portfolio to kind of have a certain level of return and a certain level of risk. And for everybody, there should sort of be a required rate of return. I've got to get 8% a year or 9% a year, or probably better to use like CPI plus a premium, but whatever it is to make all my dreams and goals come true. Well, in a perfect world, you target that rate of return, no more, no less. That's really important because the more return, the more risk. Yeah. So and this is how an actuary thinks. We immunize all the liabilities. If I need this money to be 4% more, I'm going to buy a bunch of bonds. And on that date, I'm going to have that exact amount of money that I need to cover that liability or pay that premium. And so objective-based investing. And so the portfolios have changed. As an example, as interest rates continue to go down to zero, well, looking forward, we decided, hey, bonds would not necessarily, they were breaking the rule. As interest rate, we didn't think there'd be a ton of appreciation potential, one rule breaker, and there might not be the diversification benefit either. And so the underlying securities in the portfolios changed, but really it's the same model over and over and over again with all these financial advisors.
So you just really tried to get as measurable as possible of returns, try to keep that exact same percentage to the dime as close as possible.
Yes. And to help our advisors set really good expectations with the clients. And so one of the things that was super helpful is all this quant work would also produce some expectations that an advisor could take to a client. They'd be like, look, I don't know what the market's going to do. I don't know. Probably no one does know what it's going to do. But here's the expectation I'm going to set with you. If the market is up, you're going to get 70% of the upside. And if it's down, you're going to get 50% of the downside. And let me show you why over time that's a very powerful. 70 up is a fair amount of risk, so maybe you get 50 down. Well, you want less risk, you only want 60 up, then we can go to 40 down, right? And so having a non-equal risk-reward trade-off over time is very powerful for generating wealth. Again, more up, 70 up, 50 down. And so what's really helpful though is we could set expectations, help advisors set expectations with their clients and say, because sometimes the hardest markets for a financial advisor were the up ones. Because a client would come to you like, the market's up 33%, and why am I only up 21? And it's like, this was really helpful because they would say, remember, I said you were going to get 70 up. And if I get you anything more, I want a high five and maybe we can talk about raising. And if the market's down, and so we took some of the guesswork out and say, we don't know what the market's going to do in the next year or two or whatever. Long time we're bullish, but to help them also set that expectations was super helpful.
Got you. Wow, that's very interesting. And so depending on, so right now we're in kind of an odd era of, post-COVID, it was, right after COVID or during COVID, it was zero interest rates, nothing, no demand. And then suddenly inflation spiked and so did interest rates. And now they're both starting to come back down. Mm-hmm. What do you think the market is predicting one rate cut. What do you think? First of all, do you think that's true? And second of all, what is the best way to navigate investing in bonds and, just asset allocation in general?
So here's the good news, in my opinion. Bonds are back, which is awesome, because historically, bonds, traditional bonds, treasury bonds, etc., high grade corporate bonds and stocks are great diversifiers, especially in a down market where you want them to be diversifiers. And so I think that's awesome that we're excited, like bonds are back and we don't have to get get a lot less creative. Yes. And so how do you play the bond market? Well, the good news I would argue too is, in my opinion, the expectations for interest rates is they could go up a little bit, but we're probably close to being done. They could go down, maybe we'll get a rate cut, whatever. I do think they will cut rates, because the problem is in the bond market, for a lot of reasons, because the bond market carries to financial markets and how people borrow and lend and all kinds of things, you actually should have and want a normalized or upward sloping yield curve. And as you probably know, we don't really have that because the Fed's pushed rates up on the short end and the long end hasn't moved up with that, which is good. That's saying, hey, we don't see huge long-term inflation, et cetera. But now you've got this very flat yield curve. And so I don't think that, my opinion, they don't necessarily do it to stimulate the economy, but they might actually drop rates to get this yield curve more normalized. And that, to me, should happen and probably will happen, and maybe we'll see a rate cut or whatever. I think it's hard to get too excited about some short-term data points. Yeah. And the data is great. It's really good to have data make decisions, but the data is also weak, flawed, all kinds of things. And so, I don't know that the data is necessarily a great predictor of what the Fed's gonna actually do. But I do think we'll likely see a rate cut or two down the road this year, early next year, whatever. But I think the bond market is pretty easy to play, right? Because I think you can invest in the longer portion of it and not expect, because if rates moved up there, you might see some price pressure on your bonds or whatever. And I think actually we'll see the rates come down on the shorter end, which you would see not only price appreciation. It's not super exciting to stretch out on the term curve for more yield yet, but I think you'll see that demand start to come up as rates come down. And so, I just think you play the basics, diversify in bonds as well, probably stay shorter on the curve because you're not really getting compensated to go out further. And there's kind of other risks, right? Duration risks, and you could like look at yield as a, per unit of duration. And so I like that shorter end of the curve. And, then it's a function of like, do you stretch for some yield by taking more risk over, treasury bonds, typically the safest, then muni bond, then high grade corporates and those types of things. But yeah, I think the bond market is attractive as far as relative to other bond markets and pretty easy to play right now.
And if the shorter term bonds fall, or if they do cut rates, wouldn't that mean that the longer term bonds start to fall?
They could, right? So if they start to cut rates, what you typically want is what's called a parallel shift in the yield curve. So it stays upward sloping, as it should. So you should demand, you're loaning the government money, you should get more interest for a longer term loan. And typically what you'd want to see is if the Fed raises rates on the short end, the whole curve goes up together. So yields go up on the short end and the long term. But that hasn't been happening. So this is called a twist because it's not shifting up, it's actually moving clockwise. That's called a twist. And so because it's twisted, Nick, I don't necessarily I think if they drop rates here, it'll twist back. But you're right. If they drop rates here and it's a good, healthy parallel shift, then it would all move together with continuing that upward sloping. But that's going to be more, the Fed only controls the short end. The market controls the rest of it. Sure. And it's really tied to inflation and growth expectations. And I think the market's usually right as far as it can be at this point in time. And so just because the Fed drops some rates again at the shorter end, so I don't think you got to go chase to lock in a longer term loan. If you were in some kind of business where that was meaningful, if you were immunizing liabilities in an insurance company or something, then yes, but not as a retail investor. I think there's a little bit of a misconception as well with bonds, is that thinking most investors hold them to maturity, which they don't. Which they don't anyway, right? And so we're always buying and selling them and using and those types of things. So kind of locking in that 10-year number, unless you had a really good reason to hedge that, like you're like, oh man, if I can get this for the next 10 years and I'm gonna nail this liability I've got coming due in 10 years, for sure. I see. Go lock it in.
Okay.
Yeah.
Okay.
But yeah, as in a portfolio, retail portfolio context, nah. Yeah, it's just, unless I'm going to get more yield on the higher side, I don't love going. I don't want the same yield. If I can buy a 2-year at the same yield as a 10-year right now, and my interest rate expectations are where there's just no real good reason to go chase it out there.
Okay. Yeah. Okay. And I want to switch gears back to the ETFs that you're talking about. I just have a quick question regarding the expense ratios. And when you launch ETF, you can't charge that much for an expense ratio.
Right.
What does BJK and KOL charge?
So they 65 basis points.
Okay.
Which is high for ETFs,
yes.
But they're global. So SPY used to be 20 basis points. I think it's dropped, and I know its competitors. You can buy SP 500.
Vanguard's like 4.
Yeah, 3 and 4, and those types of things. I mean, it's crazy. And so it's just kind of this race to the bottom.
Yep. And how does that get allocated? Where does most of it go to VanEck, and do you get any of it?
Yeah, it's so the business looked like this when we did our deal. Now I'm out of both of those now, but when we did our deal with VanEck, how it worked is Van Eck's going to put the product together. They're going to do the launch on the New York Stock Exchange, and they're going to actually run the investment vehicle. All we had to do was publish the index. So basically, we were the manager of the ETF, but all we were doing is making sure the index was calculating their. And so we would we cut a deal where we got 10% of their fee. So they were charging 65 basis points. We got 6.5 basis points on assets to provide that index. Now that fund was extremely successful, actually, just because of its timing. It was wildly successful, and then it got clobbered. Then it recovered, and now it's really struggling because, dirty energy is really, BJK a little different. That's continuing to thrive quite a bit more, but that fund had $1.5 billion in assets in it. That coal fund in like no time. Wow. I know it was at one time, but it may, if you look at the assets that came into it, it may have been, as far as gathering assets quickly, maybe the most successful ETF ever launched on the New York Stock Exchange.
That's very impressive.
But, boom, bust.
Yes.
I guess it depends on how long you play that out for. But in the first, 6 months, it went north of $1 billion. So even at 6.5 basis points, we're feeling pretty good about that.
Yeah. And so this isn't super related, but it reminded me. I didn't specify. I wanted to ask, what's the least amount of money that you've been in charge of managing, and what's the most probably right now that you're in charge of money?
I'll give you a quick fast forward. So Dynamic Capital, this group of financial advisors who was being run by this guy, and I started to pick up so many of them as clients, is I actually merged Dynamic Capital in with a firm called the Financial Services Network, the network. And I took over that in 2016 with two other guys. We took over the network, and we grew it then from $8 billion to $30 billion in assets. And so we had 410 financial advisor clients, $30 billion in assets. And then I was in charge of managing probably $4 billion of that. And then the other monies, the advisors were doing other stuff with it, or it was elsewhere. So at that point, I was managing about $4 billion of that. And so some advisors, one of those advisors in that $4 billion probably entrusted us with $700 million, but it's of his client's money, right? So I don't know how big the biggest client was in there.
Yep.
I did do some work. I wasn't actually managing it. I've done some portfolio design work for a large insurance company, for Delta Dental. That was billions of dollars in one portfolio. A couple of our advisors do have some large clients, and so we manage. And then I also sit on the board of couple like endowments and foundations, like some community colleges in the Central Valley that it actually wasn't the Gates Foundation. I think it was Bezos, but they put a bunch of money in, which awesome, into community colleges in the Central Valley, California. And those portfolios are $30-40 million in size, just one portfolio, but nothing huge.
Yeah.
Awesome.
And I also wanted to ask you about the mergers, first of all DCM with the network, and then the network with Mariner Wealth Advisors.
Yeah.
What is in it for you with all of these mergers? Why do these companies want to do that?
So I love the investment side of the business. I love that, but I was always driven to be, I had that entrepreneurial spirit. So as I really started to tie into asset management, I wanted to build out a business around asset management. To your point, I wanted it to be bigger, and that's why Quantitative Allocation Method, and pretty much the same recipe. Get a financial advisor, same recipe, almost like a McDonald's type of thinking. And so I love the asset management piece of it. But what I didn't love, and I have a lot of friends, and I've known a lot of other asset managers, hedge fund managers, et cetera. It's a it's a pretty live by the sword, die by the sword there. They'll all tell you that. And, you know, that is a scary way to necessarily make a living by. And so for me, it was more of building a business around it that wouldn't necessarily have a huge amount of risk, whether the market did this or that, or maybe you had a bad year in your portfolio or whatever. And so I was creating a business around that with the network. And financial advisors are with our client. And so with the network, really what I saw was an opportunity. There's a trend in the industry where, and it's just continued, where advisors were leaving more and more. They were leaving the larger, let's call them a wirehouse, Merrill Lynch, Morgan Stanley, you know, Goldman Sachs, you name it. They were working for these really big companies, but they were leaving and they were going independent. And there's a lot of really good reasons that they would go independent, to include, now they're not working for a big company, they actually own a business. It's great for an entrepreneurial advisor to actually take their business out and build a business that they actually have value in and maybe one day can sell and have complete autonomy and control over. And so there's this big trend happening. And so with the network, the network was starting to attract some of those advisors. They would offer them a place to land and give them compliance and some technology and a couple other things. And we saw this opportunity to add asset management as another service to the network and start to build this platform out of technology and services and access to custodians, et cetera, to build a platform out for those financial advisors to land. If you work for Merrill Lynch and you're a financial advisor, Merrill Lynch is going to ask you to go out and gather clients and do what you do as a financial advisor, and they're going to give you all those resources, et cetera. But you work for Merrill Lynch.
Yes.
You may be an independent contractor to Merrill Lynch, but you're branded with Merrill Lynch. Merrill Lynch might even own your clients. Independent means I'm going to leave Merrill Lynch and, you know, I'm going to set up Nick's financial advisor house, and I'm going to own all my clients, and I'm going to make a decision on what office literally independent means you go be an independent business owner. And I loved it because now I'm not just in the asset management business, right? It's not super sexy, but compliance in this heavily regulated industry sucks. And for us to build something out good to help the advisors do that, because they need that when they lose Merrill. And so I just saw the opportunity to diversify out of my business and grow something much bigger. I know you're talking to other entrepreneurs. One of the drivers for me was wanting to create something that had real enterprise value and to grow that. And so I just saw that opportunity starting to come together. And so I was able to merge and plug the asset management side into the financial services network as that continued to grow. Me and two other guys, actually, it was owned by a guy named Jim Harrington for a long time. We actually bought Jim out and we took it. It was about $8 billion in assets, maybe 80 advisors. And then that was 2016. And then we continued to grow it, building out technology and services. And COVID was like a home run for us, right? It was like a lot of fintech or platform types of businesses. All of a sudden, advisors were, the guys at Merrill Lynch were like, I don't even go to Merrill. Like, I've just realized, like, I don't need the fancy. I don't have to give up half of my income for the fancy office. Like, I'm doing this from my home anyway. Maybe I should go independent. And so that not only created a lot of business for us to then sell a financial advisor on our platform. I mean, we used to go out, our salespeople would go out and meet the financial advisor in Georgia. And all of a sudden, they went from being able to do 5 sales calls in a week to they could do 5 sales calls in a day.
Yeah. And the network was a space for these financial advisors to come and do that on their own.
We were almost, in many ways, we're like, Merrill Lynch is like the front of the house and the financial advisors drafting there. The network was like a behind the scenes back office. So you're your own business, you do your DBA, you do what you want. You still need compliance, and access to custodians like Schwab and Fidelity, maybe an asset management team, et cetera, et cetera. And so we were the back office behind the advisor now going sort of to the front of the house and having their own business. Yeah.
I see. And we'll wrap up with just a few more questions. First of all, as a investor, I'd love to hear your take on just the tech space, NVIDIA, AI bubble, all of this stuff. What do you think is the right move right now? Do you think, like you said, NVIDIA is the S&P right now?
Yeah.
Do you think the best option is to just leave your money in a mutual fund, or do you think you should be a little more risk averse? What do you think? What's happening right now? What's the move?
The best move is for a guy like you, because you've got so much time and I'm certain going to generate a lot of income that you're going to be able to invest. You're killing it, by the way. It's been really fun to get to know you, and it gives me hope for the future of this country meeting. I mean that sincerely. It's a really easy equation for you, in my opinion. I don't think, my advice would be, you don't get fancy. I'm not a huge fan of mutual funds per se, because I think the ETF is a better wrapper.
Yeah, I should have phrased that better. ETF.
That's okay.
That's okay. Anything like that.
That's okay. But I think that, if I'm you, I'm not trying to pick
The winners.
pick necessarily the next big winners, but I'm just stuffing as much money into a couple ETFs. And when you open that statement in 20 years or 30 years, you're going to be pleasantly surprised. Overthinking it is your enemy. And I don't mean, you don't keep your eye out for the next NVIDIA or the next great thing and do you put some money there. I mean, that does make a lot of sense. But playing the short game it would work against you, and your time is better served doing what you're doing. Save as much money, stick it in a bunch of ETFs in 10 or 20 years, then you're going to be pleasantly surprised. And for the investors that don't necessarily have the cash flows coming in, or the time horizon per se, I'm very bullish actually on the stock market. Be that as it may, I don't think it's about necessarily overanalyzing the time and the time and space for that. It would be like, look at the quantitative allocation method, look forward, and set some expectations around, what you think stocks might do and bonds might do, and make sure you target a rate, whatever rate of return you kind of need, whether that's 5 or 7 or 10, whatever, get there. And then make sure you're as diversified as portfolio to really get there. Because if you're taking too much risk right now, then I'm wrong. I'm not bullish on the stock market, and you get clobbered. And you get extra clobbered because you thought AI is going to, be the next, which it probably will. But you can make some really bad investment decisions based on really good ideas. And of course, the whole world, that we have so much global uncertainty, et cetera. There's these outlying events, and so you really get precise on, I don't want to take too little risk, I don't want to take too much risk, I want to be right in that sweet spot, and then how am I going to diversify in order to do that. And I do think, as you probably studied in business school, in a perfect world, you want to diversify away, your non-systematic risk, right? So you can't be overweighted in too many stocks to do that, right? Then you're picking up some of that, non-idiosyncratic or non-system risk. So if you're playing the risk game, you're going to diversify that away anyway. So you might as well just buy ETFs. And
that makes sense. Yeah, I get that. And if you could go back in time, this is the last question I ask everybody on this. If you go back in time and give your 20-year-old self one piece of advice from all of your experience, what would it be and why?
You didn't tell me you were going to ask me that question. And I mean, really difficult answer, because I made massive mistakes personally and professionally, and as much as I would want to give advice to have stepped over some of those landmines, they have made me the person that I am today, right? I mean, that being said, I do wish that I had, and I was a fairly good saver and fairly conservative, but looking back in time and seeing the time value of money and those types of things, I wish I had invested more. I do, frankly, I wish I'd spent more time. My dad passed away when I was fairly young in my career, and I would have said, spend less time with those friends that you actually know aren't awesome friends, and more time with your dad and family.
Yeah.
But that's about all I got.
I see.
Yeah.
Awesome.
Yeah.
Well, thank you so much
my
for
pleasure.
joining the podcast.
Yeah.
I do really appreciate it.
Yeah.
If you guys are watching on YouTube, please subscribe and like. And if you did enjoy it, go ahead and share with 1 or 2 friends who you think will also be very interested in Jeremy's extensive career. And follow on Spotify and Apple Podcasts, and all the socials at Tahoe Minds will be in the description below. So yeah, go ahead and follow, and thank you for tuning into this week's episode.